Welcome to the Deep Dive. We're the place that takes that pile of articles, data, and research sitting on your desk, or let's be honest, in your browser
Yeah.
tabs. And we basically synthesize it for you. We help you get up to speed fast on the critical knowledge points. And today, we're tackling something pretty fundamental. It looks like major shifts are underway in the global economy, and one of our listeners wants to really understand the drivers. They've given us some great source material pointing towards, well, three big interconnected trends: the growing power of finance, how that lets weaker companies survive longer than they should, and then the knock-on effects, especially around automation and jobs.
It's a really crucial set of connections to explore. These aren't just separate issues happening in isolation. No, they feed into each other. What happens on Wall Street, or, the City of London, directly shapes corporate strategy. And that, in turn, affects labor markets everywhere from, say, Germany to Brazil. And the concept that really ties it all together, the bedrock idea, is what economists call financialization.
Okay, financialization. That sounds a bit academic, maybe. Let's unpack that right away. Simple terms first, Feynman style. What are we really talking about?
Right. It's not just, the finance exists. Banks, markets, they've always been there. Financialization is about proportion and power. It's this broad process where financial markets, financial institutions, and kind of the mindset of financial elites gain significantly more influence over economic policy, over economic outcomes, and really critically over how the real economy, the part that makes actual stuff and provides services, decides to use its resources.
Oh, okay. And the source material had a great analogy for this, which really helped me visualize it.
Yeah, it's a good one. Think of the whole economy like a dog, right? The real productive part, making cars, growing food, coding software, building houses, that's the dog itself. The body, the financial sector, banking, lending, creating stocks, all that's the tail. Now, normally the dog wags the tail. The needs of the real economy should drive what finance does.
Makes sense.
But under financialization, that tail has grown enormous. It's become so heavy, so dominant, that the tail is now wagging the dog. Financial priorities, like short-term shareholder value or complex derivative trading, start dictating what the real economy does, rather than the other way around.
And the research you looked at from the Levy Institute makes it clear this isn't just theoretical. It has real, tangible effects on people's lives.
Oh, absolutely. The core impact is a kind of systemic shift in where income flows. Financialization tends to pull income away from the real economy, away from workers' wages, away from long-term investment in factories or R&D, and redirects it towards the financial sector. Think fees, interest payments, rising asset values benefiting owners.
Right.
And this mechanism is identified as a major driver behind two huge trends we've seen globally for decades now: rising income inequality and, for many, many workers, stagnant wages. The financial tail grows while the productive body, well, it struggles.
Yeah. So our mission today for our listener is to connect this big picture, this financial dominance, to two really concrete symptoms, things we can actually see and measure. First, this weird phenomenon of unproductive companies, these zombies that just won't die, fueled by cheap debt. And second, the complicated, sometimes paradoxical effects of automation on jobs and even on national development strategies, using some really detailed data.
Exactly. We're drawing on studies from places like the Bank for International Settlements, BIS, which tracks companies across 14 advanced economies, plus that Levy Institute work on the macro picture, and then some very specific firm-level data from the OECD and researchers digging into places like Brazil. So a good mix of perspectives.
Okay, let's dive into that first major symptom then, this idea that the very nature of corporations is changing because of this financial pressure. The American Compass research talks about a really fundamental shift in how businesses see their role and, crucially, what they do with their profits.
Yes, this is arguably one of the most significant transformations in business over the last, say, 40 or 50 years. The traditional view of a corporation was as a productive investor. It builds things, it innovates, it focuses on long-term growth, reinvesting profits to expand. But the trend described is that they're morphing into something more like cash dispensing machines. The primary goal shifts from building the future of the company to just distributing cash back to financial markets now.
Disgorging capital, as they put it, pushing cash out the door instead of reinvesting it in new equipment or R&D. Now, hang on. Some would argue that's efficient, right? If a company doesn't have great internal projects, maybe returning cash to shareholders lets the market find a better use for it.
That's the classic argument, yes. And in theory, it could work that way, but the research we're looking at strongly suggests that's not always what's happening. A lot of that disgorged capital doesn't seem to flow back into building new productive capacity in the real economy. Instead, it often gets caught in the financial system itself. It fuels speculation, it bids up the prices of existing assets, stocks, bonds, real estate. Rather than creating new wealth and new factories, it stays in the financial feedback loop.
And there's data backing this up, this feeling that the real economy isn't benefiting as much.
Yeah, the timing is suggestive. The period typically associated with accelerating financialization, say post 1979 or 1980, has also been a period of generally slower, more tepid economic growth in most major developed countries. The Levy Institute points out, for instance, U.S. per capita growth averaged about 2.2% before 1979, but only 1.9% after. That difference might sound small.
But compounded over decades, that's a huge amount of lost growth potential.
Exactly. It represents trillions in missed economic output. And you can see the mechanics of this shift in how companies finance themselves. There's a really startling finding in the data about equity issuance. For non-financial corporations, net equity issuance, basically, selling new shares to raise capital, turned negative after 1980, and it largely stayed that way.
Wait, negative. How can the stock market, which is supposed to provide capital to companies, become a net drain?
It means companies, in aggregate, were pulling more money out of the stock market than they were putting in through issuing new shares. And how are they doing that? A huge driver was using corporate borrowing, taking on debt, not primarily for building factories or R&D, but to finance stock buybacks.
So borrow money, use it to buy back your own company's shares,
Yeah.
which reduces the number of shares out there.
Which pushes up earnings per share, often boosts the stock price in the short term, makes executives look good, pleases activist investors.
Right. It fits the financial logic perfectly. Maximize shareholder value now.
Precisely. It aligns perfectly with the demands of a financialized market focused on immediate returns. But it potentially decouples the company's financial activities from its actual long-term productive health and investment needs. And that contributes to the overall slower growth picture.
Okay, so this environment, lots of focus on financial returns, lots of cheap debt available, it leads directly to our second symptom, which feels really counterintuitive for capitalism: the survival of weak companies, the rise of the corporate zombie.
Yeah, the zombie firm is a fascinating and frankly worrying phenomenon. Its existence is like a flashing red light signaling that the system for allocating capital isn't working efficiently. In a textbook healthy market, weak, unprofitable firms are supposed to fail. Their assets, people, equipment, market share get released and hopefully picked up by stronger, more innovative companies.
Survival of the fittest, basically.
Right, but zombies, they don't die. Let's make sure we use the specific definition from the BIS research here because it's quite technical but important.
Okay, lay it on us. What officially makes a company a zombie?
All right, according to the BIS, a zombie firm is a publicly listed company, not in the financial sector, that meets two criteria and, importantly, meets them for 2 years running. First, it's unprofitable in a very specific way. Its interest coverage ratio, or ICR, is less than 1. Second, the market doesn't think much of its future. Its stock market valuation, measured by Tobin's Q, is below the median for firms in its same industry or sector.
Okay, let's translate those. ICR less than 1. That means its current earnings aren't even enough to cover the interest payments on its debt.
Exactly. Think about your household budget. If your income isn't enough to even pay the interest on your mortgage and credit cards, you're in deep trouble. You can only keep going by borrowing more just to make those interest payments. That's an ICR below 1. It's fundamentally bleeding cash on an operating basis.
Ouch, okay. And the second part, Tobin's Q, what's that telling us?
Tobin's Q compares the company's market value, what investors are willing to pay for its stock, to the estimated replacement cost of its assets. If your Tobin's Q is low, especially below the average for your peers, the market is basically saying, we don't think this company is worth even the cost of rebuilding it from scratch. It suggests investors have very little confidence in its management or future prospects compared to competitors.
So a zombie is both bleeding cash now and seen by the market as having a pretty bleak future.
Correct. Unprofitable and poorly valued, consistently.
Which makes my second analogy for today, economic life support, seem pretty apt. These firms probably should have failed, freeing up resources, but they're kept alive artificially.
And the reason they can stay on life support is largely that environment of easy credit we talked about, a key feature of financialization. When borrowing is cheap, even weak companies can manage to roll over their debts or find new loans to just keep going.
And this isn't just a few isolated cases. The scale is significant.
It's quite alarming, actually. The BIS study looked across 14 developed economies. They found the share of these zombie firms rose from around 4% back in late 1980s to about 15% by 2017.
15%. Wow. So roughly 1 in 6 or 7 large public companies in these advanced economies fit the zombie definition by 2017.
Yeah, it's a substantial chunk of the corporate landscape. And these aren't just dormant companies waiting for a turnaround. The data shows they perform worse on almost every metric.
How so?
They're less productive than healthy firms. They tend to be smaller. They invest less both in physical stuff like machines and in intangibles like R&D. And crucially, their employment is often shrinking. They're shedding jobs, reducing their assets, even while they manage to stay alive. But the real damage, the systemic problem, isn't just their own poor performance. It's what the economists call congestion effects.
Congestion, like traffic jams.
Kind of. By sticking around, these zombie firms clog up the economy. They tie up resources that could be used more productively elsewhere. Think about it. They absorb bank credit that could have gone to a dynamic startup. They occupy factory space or retail locations that a growing firm could use. They keep mediocre management teams in place. They might even bid up wages locally just enough to make it harder for healthy firms to hire. They basically prevent the smooth reallocation of capital and labor from failing ventures to promising ones, which is essential for economic growth.
Okay, that raises a huge question then. Why are the banks, the creditors, letting this happen? If a bank knows a company's a zombie, why keep lending to it? Why keep rolling over the debt, evergreening it, as the research calls it? Why not just cut their losses?
That's the million-dollar question, isn't it? And it points to a potential systemic flaw. Low interest rates, while perhaps intended to stimulate the economy, also mechanically reduce the pressure on banks to deal with bad loans. It becomes easier and often preferable from the bank's own balance sheet perspective to just keep the loan technically alive, keep rolling it over, rather than formally recognizing the loss.
Because recognizing the loss means taking a hit to their own capital.
Exactly. Admitting the loan is bad forces the bank to write it down, which impacts their regulatory capital ratios, their profits. By evergreening the loan to the zombie, they can postpone that pain, even if it means keeping an unproductive firm alive and ultimately damaging the wider economy. It's a perverse incentive created by the interaction of low rates and bank regulation.
Which leads us neatly to our first knowledge gap for you, the listener, to ponder. Knowledge gap 1. What specific policy changes or market mechanisms could actually force creditors, the banks, to confront these bad loans sooner? How do you make them clean up their balance sheets and stop propping up zombie firms, ensuring capital flows to where it's actually productive? It seems like we need a way to make pretending more costly than facing reality. Okay, so far we've seen how financialization can distort corporate behavior in advanced economies, creating cash machines instead of investors, and keeping zombie firms alive. Now let's shift gears a bit and look at how another huge force technology, specifically automation, interacts with this kind of fragile economic backdrop. And we're going to focus on an emerging market example, Brazil.
Right. This part of the research is fascinating because it shows how tech choices made in, say, Germany or the US can have really direct and sometimes quite complex impacts on trade partners like Brazil. But before we dive into the findings for Brazil, we need to quickly explain the method the researchers use because it's a bit technical but key to understanding the results. It's called the shift-share approach.
Okay, Feynman, step 3. Simplify the complex bits. Let's break down shift-share.
So imagine you want to know how the rise of industrial robots is affecting jobs in Brazil. You could just count the total robots adopted in Brazil, but that's too broad. The shift-share approach is smarter. It looks at the starting point of different regions within Brazil. What industries were already dominant in specific cities or states before the big robot boom?
So it's about pre-existing exposure.
Exactly. Let's say you have 2 Brazilian regions. Region A has historically relied heavily on car manufacturing, an industry that's automating rapidly worldwide. Region B relies more on maybe tourism or local services, which are less exposed to global manufacturing automation trends. When robot adoption surges globally in the auto industry, Region A is naturally going to feel that impact much more strongly than Region B, just because of its initial industrial mix. Shift-share math helps isolate that differential exposure to estimate the local job effects.
Got it. So using that approach, what do they find about automation within Brazil first? Domestic automation.
Well, here the story looks somewhat similar to what we've seen in many advanced economies. It creates a kind of skills polarization. Domestic robots tend to replace routine, often manual tasks. So the data showed a decrease in employment for roles like plant and machine operators, about 0.03 percentage points lower employment ratio for every robot increase per 1,000 workers. Direct replacement.
But automation often creates new roles too, right?
It does. Robots need programming, maintenance, supervision. They enable more complex production processes that need oversight. So the same data showed an increase in the employment ratio for higher skilled roles like managers and professionals, up by 0.07 percentage points per robot increase. These are the jobs involving non-routine cognitive tasks that complement the technology.
Okay, so far so familiar. But the really mind-bending part was the effect of automation happening outside Brazil, right? Automation in other countries affecting Brazilian jobs through trade.
Yes, this is where it gets really complex and revealing about global interdependencies. Automation abroad ripples through supply chains and changes who produces what, where. The research identified two main channels for this. Let's take the first one, which was generally negative for Brazilian manufacturing, the final goods channel.
Okay, final goods. So when factories in, say, the US or Europe get really efficient with robots,
Their cost of producing finished goods, like cars or electronics, drops significantly. It suddenly becomes much cheaper to make those complex products back home, or at least closer to home than it used to be. This can lead to reshoring, bringing production back from overseas, or nearshoring. Basically, the advanced economies become more competitive in manufacturing again, thanks to the robots.
which means they need to import fewer finished goods from places like Brazil.
Precisely. The demand for Brazilian exports of manufactured final goods goes down. The study found this effect was particularly noticeable in sectors like automotive. Overall, this channel led to about a zero point 0.1 percentage point decline in Brazilian manufacturing employment in the regions most exposed through trade. Brazil loses some of its edge in making finished products.
But there was another channel working in the opposite direction, wasn't there? The input goods channel.
Yes, and this is where the picture gets more nuanced and maybe more worrying in the long run. While demand for Brazilian finished goods might fall, the global manufacturing boom, fueled by automation, increases the demand for raw materials and basic inputs. Things like iron ore, soybeans, basic components.
Things that Brazil is rich in and can still produce relatively cheaply.
Exactly. So foreign automation actually boosted demand for these primary commodities and simple inputs from Brazil. This led to an increase in employment in sectors like mining and raw materials extraction, up by about 0.04 percentage points in exposed regions.
So let's put those two effects together. Foreign automation reduces demand for Brazil's manufactured exports, but increases demand for its raw material exports. What's the overall impact?
The researchers conclude that the net effect points towards something they call premature deindustrialization. It's a really strong claim.
Premature deindustrialization. That sounds bad. What does it mean?
It means that instead of the economy naturally moving up the value chain from basic resources to simple manufacturing to more complex, high-tech goods technology is effectively pushing Brazil backwards. It risks shifting the focus away from developing a diverse, sophisticated industrial base and towards becoming more concentrated on simply extracting and exporting raw materials.
Which makes the economy more vulnerable to commodity price swings and less likely to develop high-wage, high-skill industries long-term.
That's the concern. It shows how technological progress in one part of the world can, maybe unintentionally, reshape and potentially simplify the industrial structure of its trading partners in ways that might not be beneficial for their long-run development.
Wow. Okay, let's connect this back now to our earlier theme of investment and productivity, but looking specifically at those non-physical assets, intangible capital. This feels increasingly important in the digital age.
Absolutely. Intangible capital is fundamental to how firms adapt and compete today. The OECD research breaks it down into roughly three buckets, which helps clarify what we mean. First, there's innovative property. This is the classic stuff. R&D spending, patents, copyrights, designs. Second, digitized information. Think software, databases, digital content. And third, and this one seems particularly important based on the findings, is economic competencies.
Economic competencies. It sounds a bit fuzzy. What kind of things fall into that category? How do you even measure it?
It represents the investment a firm makes in being able to actually use the technology and information effectively. It includes things like redesigning its organizational structure, improving management practices, investing in workforce training and skills development, building brand value. Measuring it is tricky, but researchers might look at spending on management consulting or estimate the value of managerial time spent on strategic reorganization or track investments in worker training programs. It's the soft capital needed to make the hard tech work.
Okay. And the OECD found a strong link between this intangible stuff and the productivity gap between firms.
A very clear link. They found that industries investing more heavily in intangibles also tended to show a wider gap or dispersion in productivity between the top performing firms, the frontier, and the bottom performing firms, the laggards. The specific number was quite striking. On average, a 10 percentage point increase in how much an industry invests in intangibles was associated with about a 1.5 percentage point increase in that productivity gap, measured as the difference between the 90th and 10th percentile firms.
So more intangible investment seems to correlate with greater inequality between firms in the same sector. Did they figure out which type of intangible was driving this most?
Yes, and this was a key finding. It wasn't primarily the R&D or the software investment that correlated most strongly with the widening gap. It was the investment in economic competencies.
The organizational stuff.
Mhm.
Management, training structure.
Exactly. It suggests that just buying the latest software or doing R&D isn't enough. The firms that really pull ahead are the ones making those complementary investments in how they operate, how they're organized, how their people work. That seems to be the key differentiator driving the productivity dispersion.
And this widening gap, was it just the top firms getting better, or were the bottom firms falling behind too?
It was happening at both ends, which makes it even more concerning. The gap widened because the frontier firms, the top 10%, were pulling further away from the median firm. The 90-50 gap increased. But it also widened because the laggard firms, the bottom 10%, were falling further behind the median. The 50-10 gap also increased.
So it's a double problem. The best are getting much better, and the worst are getting comparatively worse.
Right. This points to two related failures. First, a failure of knowledge diffusion. Whatever those frontier firms are doing right in terms of organization and management isn't trickling down effectively to the average or below average firms. And second, it likely reflects the financial constraints we talked about earlier. Those laggard firms probably find it hardest to secure the funding needed for those big, risky investments in organizational change, even if they knew what to do. ###4. Future implications and policy considerations.
Okay, let's try to tie all these threads together now. We have this picture of financial dominance, zombie firms, automation paradoxes, and growing productivity gaps linked to intangible investment. The Levy Institute research argues that this whole situation is kind of locked in place, or at least reinforced, by a particular set of policy choices made over the last few decades.
Yes, they use a pretty evocative metaphor for this policy environment. They call it the neoliberal box, or sometimes the policy prison.
Right, let's unpack that metaphor carefully, just presenting the analysis from the source material here. They argue workers and the productive economy are kind of boxed in by four walls. What are those walls, according to their analysis?
Okay, the first wall is globalization, specifically the emphasis on free capital mobility and the constant pressure from global competition for goods and labor. This tends to put downward pressure on wages and limit domestic policy options. The second wall is small government. This represents a policy preference for deregulation, reduced public spending, fiscal austerity, and tax policies often seen as favoring corporations and capital owners over labor.
Okay, two walls down.
The third wall is labor market flexibility. This refers to policies aimed at weakening unions, reducing worker protections, and making it easier to hire and fire, which collectively reduces the bargaining power of workers. And the fourth wall is the abandonment of full employment as a primary policy goal. Instead, macroeconomic policy, particularly central banking, becomes heavily focused on keeping inflation extremely low, even if that means accepting higher levels of unemployment or slower wage growth than might otherwise be possible.
So the argument is that these four policy walls interact to create an environment that constantly squeezes labor, reinforces inequality, and makes it harder to address the problems like wage stagnation or the lack of productive investment we've been discussing. Any potential solution has to somehow break out of this box.
That's the core argument presented, yes. And based on that diagnosis, the research suggests the most urgent need is to regain some control over the financial system itself, given its role as the tail wagging the dog. But our main tool for doing that is flawed.
You mean the central bank's interest rate?
Exactly. The research calls the short-term interest rate a blunderbuss. It's powerful but incredibly crude. If you raise interest rates high enough to really curb financial speculation, stop asset bubbles from forming, or maybe put pressure on banks to finally deal with zombie loans.
You risk hammering the entire economy.
Right. You inflict serious collateral damage on the healthy parts of the real economy, the firms that are investing, hiring, growing. You can easily trigger a recession that hurts everyone. It's too blunt an instrument to fine-tune financial behavior without causing broader harm.
So the argument is we need more targeted tools, scalpels instead of a blunderbuss.
Precisely. The Levy Institute research, for example, strongly advocates for exploring tools like asset-based reserve requirements or ABRR. These are seen as a potential way to influence financial behavior more precisely.
Okay, ABRR. How would that work differently? How is it more targeted?
Instead of just changing the overall price of money, the interest rate, ABRR targets the composition of bank lending. Regulators could require banks to hold more capital reserves against certain types of assets deemed riskier or more speculative, like maybe loans to highly leveraged firms, or certain kinds of complex derivatives, or perhaps even evergreen loans to known zombies. By making it more costly for banks to fund speculative activities compared to, say, funding productive business investment, you could potentially cool down dangerous financial behavior without having to slam the brakes on the entire economy with high interest rates. It's about changing the relative incentives. And beyond just tweaking the regulatory dials, there's a call in the research to fundamentally rethink the legal purpose of corporations. To move away from the dominant ideology of shareholder primacy, the idea that a company exists only to maximize returns for its shareholders, and towards a model that legally recognizes the interests of other stakeholders too: employees, customers, suppliers, the environment, the community. This would directly challenge that cash dispensing machine model driven purely by short-term financial returns.
Okay, that addresses the financial side. What about the productivity gap and those laggard firms struggling with intangibles? The OECD research pointed to a specific bottleneck there.
Yes, the pledgeability problem. This is a really practical hurdle. When a company wants a loan, banks like collateral of something physical they can seize and sell if the loan goes bad. A factory, a machine, inventory. Those are pledgeable assets. But intangible assets, the R&D pipeline, the brilliant new software code, the improved management structure, the brand reputation, these are much harder, sometimes impossible, to use as collateral. They're non-physical, their value is uncertain, and you can't easily repossess them.
So the very investments that seem most crucial for laggard firms to catch up those organizational changes, the economic competencies, are the ones they'll find it hardest to get traditional bank financing for.
Exactly. It creates a major financial friction, especially for smaller, potentially riskier firms that don't have huge physical asset bases to borrow against. They're stuck. So, the OECD research suggests policies aimed directly at easing this friction. One idea is finding ways to improve the pledgeability of intangible capital, maybe through specialized government loan guarantee programs or developing markets for IP-backed loans where intellectual property itself can serve as collateral.
Makes sense. Any other approaches?
The other main suggestion is more targeted government support. Not just broad R&D tax credits, but perhaps grants or incentives specifically designed to help firms undertake that difficult, costly organizational restructuring needed to actually implement new technologies effectively. The goal is to directly support investment in those economic competencies, which seem key to boosting productivity, especially for firms currently lagging behind. This could help narrow that productivity dispersion from the bottom up. And reflecting on all this brings us to our final couple of knowledge gaps. These are big, tough questions emerging from the research for you, the listener, to chew on.
Okay, let's hear them. Knowledge gap 2. We see that economic competencies, the organizational know-how, seem critical and lacking in laggard firms. But money alone might not be enough. What specific policies or initiatives could actually promote the diffusion of that crucial management and organizational knowledge from the frontier firms down to the laggards? How do you share best practices effectively across an economy?
It's a huge challenge, and that leads to the final, perhaps most fundamental gap, knowledge gap 3. Given how influential the financial sector has become, influencing policy, shaping that neoliberal box, how can political and regulatory reforms effectively diminish the political power of finance? How do you prevent the financial sector from continually reshaping the rules in its own favor, potentially recreating that policy prison time and again, regardless of electoral outcomes? It's a depth question about political economy.
We've certainly covered a lot of ground, but the story, when you connect the dots, feels disturbingly coherent. You have the rise of finance, changing corporate priorities, leading to less productive investment, and the strange survival of zombie firms kept alive by cheap debt. This creates congestion, hindering healthy growth. At the same time, technology like automation is reshaping global production in complex ways, potentially pushing economies like Brazil towards less sophisticated industries. And the key investments needed to adapt intangibles, especially organizational ones, are hard for lagging firms to make.
It really paints a picture of an economic system potentially optimizing for the wrong things, short-term financial gains over long-term productive capacity. So, the final thought we want to leave you with is this. Consider the deep consequences when an economy consistently seems to prioritize, or at least enable, financial maneuvering and asset price inflation over the perhaps harder, slower work of building real things, developing new processes, and investing in people. Ultimately, the research suggests that the survival of the fittest in the productive parts of our economy might depend heavily on how effectively we can manage and regulate the flow of capital and credit, on whether we can, metaphorically speaking, get that financial tail to serve the economic dog rather than the other way around.